Late last year, Kyle Busch and his family, yes, the race car driver, filed suit against Pac Life for some index universal life policies that they bought to the tune of about $18 million of premium that were not performing as they had expected. They were expecting, after paying $18 million worth of premium, that they would receive about $90 million or so in retirement income. They didn't see that happening. So about $10 million of premium payments in, they canceled the policies and filed suit. Now Pac Life, here in the last few days, has pushed back and asked for a dismissal in the case because the Busch family didn't live up to the end of the bargain, they allege. It's alleged that the Busch family was supposed to, as they had signed papers agreeing to do so, it was supposed to keep watch on the policy and to fund the policy correctly, according to the illustrations. And Pac Life is saying they didn't do that. So here's what I want to do. I want to show you how IULs work so that you don't make the same mistake. Let's get into it. First things up, we have two buckets, okay? We have bucket number one. Let's see here. Let's get into it. We have bucket number one. This one belongs to the insurance company, okay? Then we have bucket number two. This one belongs to you. This is where your cash value and all that lifetime income, or if you want to do some other investments, real estate, whatever, the money comes from this bucket. So using an example of $500 per month premium, let's do that. Let's show you how these buckets work together. So you've got $500 that you put into the bucket. The insurance company is going to charge you a percentage of that to run the policy. Let's say that costs $70 per month, but you're paying $500, right? So what happens is that $430 goes into bucket number two, the one that you own. That happens every month. At the end of the year, the insurance company goes out into the market and they find somebody like the S&P 500, and they look at what the S&P 500 has done. Was it negative? Was it positive? Or did it just go flat? Right? So depending on how the S&P 500 did, they give you a credit to your bucket number two. So let's just say the S&P 500 did a 4% return. So 4% of 430 is $17.20. I'm just going to round that off to $18, okay? We'll use 17. So every month, you'll get like a $17 credit in your bucket number two. Of course, that adds up over the year, over the multiple years, decades, so that when you get the opportunity, when you want to, you can pull money out of this bucket tax-free. You're not in the market. You're just watching the market to see what it does, and you get a credit based on market performance. If the market goes negative, like it does sometimes, right, then you won't get anything added to bucket number two. But the important thing to look at for bucket number two is that there's a floor. You won't lose any money in bucket number two. Your cost in the IUL is all in bucket number one. You got to stay ahead of this number. You could pay as little as $70, but if you do, none of your money goes into bucket number two, and that means you don't get any credits to increase the value of money over here. So you got to stay ahead of that. I'm not sure that's what the Bushes did. That's what Pac Life is alleging. But if you get one of these, this is what you need to watch out for.